All right, folks, we're going to talk about creating your own personalized Social Security. Now, why is that important? We all know Social Security most likely is going to run out by the time we need it for retirement. So, how do you create your own personalized Social Security? Now, what does that mean? It's very simple. We all have jobs, and when you actually have a check come in, what do? They take money out from your check to go into Social Security for other people to have. The problem is you may not get access to that money. So what do you need to do is create your own personalized Social Security where you're putting money into yourself that you could get back for yourself. Now that's done through something we like to call a fixed index annuity. Fixed index annuities allow you to have a lifetime income to pay out like a Social Security, like a supplemental income, which could be huge even after the principal's gone. So you could have $100,000 that you have in a fixed index annuity that could grow up to $300,000, but you're taking out a certain amount of money for the rest of your life as income, which could amount to $400,000, $500,000, $600,000 taken out, even after the initial premium and principal has been exhausted. Now, there's a few things you need to know about fixed index annuities. Number one, big misconception is that it's tax-free. It is tax-free on the growth. So when you have a fixed index annuity, when the money starts to grow, it's a tax advantage account. But it depends on how that money comes into the account. What does that mean? If you're rolling over, a lot of people talk about rollovers. I'm gonna have an old 401k, let me roll it over into an annuity or to a fixed index annuity. You still will have taxes on the initial money coming from a 401k. Why is that? Because that is a taxable account. So you're going to hear a term when it comes to that as qualified or not qualified for taxes. Now, what does that mean? Depending where the money comes from, it's either going to be qualified to be taxed or it's going to be non-qualified not to be taxed. So a 401k will be qualified funds because it's still qualified to pay taxes when you roll your 401k into a fixed index annuity. Now, if you have a settlement or you have $50,000 in your regular bank account, you could put that $50,000 into a fixed index annuity. That's not qualified. It's not qualified to be taxed because it's already been taxed previously. So once that's taken care of, all the rest of the money gets to grow tax-free within a fixed index annuity. That's the tax advantage portion of a fixed index annuity. Now, those are pros, excellent pros. It gets to grow tax-free, but you have to remember fixed index annuities are long-term strategies. Most of them cannot be touched until you're 59 and a half years old. And most of them, they're going to have a surrender charge, a decreasing surrender charge if you want to cancel the strategy. So if you have a 10-year annuity, typically speaking, not all, but if you had a 10-year annuity, the first year may be a 10% penalty, then the second year 9%, third year 8%, so on and so forth. So you got to understand, you cannot just take all that money out and not expect to have any cost of fees or surrender charges that's going to actually hit. But most fixed index annuities allow you to have a certain percentage you could take out every year penalty free. Some may be 7%, some may be 10%. So you put $10,000 into a 401k and then you move that $10,000 to a fixed index annuity, you may have access to just 10%, $1,000 for that year, penalty free. So you have to remember how that works with your fixed index annuities. So is it the best strategy? Not necessarily, but it's a great strategy that lets you accumulate funds tax-free. Because I'm not going to say companies, every strategy is different. But some of these companies are averaging 7%, 8%, a few of them even 10, 11% yearly, and it's indexed. Now, why is it important that it's an index account is what? Index means you have a floor and a cap. Specifically a floor, zero. Zero is your hero. Meaning if your fixed index annuity is attached to a market that drops down, we're in 2024, let's say that market that year drops down 12%, you have a floor, you're not losing anything. Why is this important? Because in 2022, that's what happened. The average 401k lost 19.3% in 2022. So if you had a 401k or some of your IRAs or some of your stocks, you saw a decrease. But if you had an index account, you didn't have any losses. So that's the power of having a fixed index annuity. Many different strategies, many different ways, many different years. You could have a 5-year, 7-year, 10-year. I have some 14-year annuities where you could have that money structured where it can keep growing with compound interest. There's a lot more research that needs to be done, but if you have an old account of 401ks or IRAs or just money in your account that you want to have tax advantage so it could grow, go ahead and reach out to me. Check the link in the description for some other financial tools that you guys could use. And I hope this is a great breakdown for fixed index annuities, a strategy many people are not aware of, and there's a lot of misconceptions. So there are pros, there are cons. You need to learn how to use it correctly. So with that being said, it's Earl the Money Coach. Like, comment, subscribe, give a follow to the channel, and check the link below in my description for some great tools that you guys can use.